Good morning. Welcome to Wayne's World, the last full week of February, and we're now starting to think about doing our taxes or asking for an extension. So Wayne's World today is going to give you a tax update in 2023. Before we do, you have to realize my philosophy as a wealth whisperer, as a person who has the 10 commandments of wealth building, and wants you to buy 2 income properties a year, every year you're a realtor, does not have a problem with being audited. I feel that the only way I'll know if I pay the least amount of taxes is until I've been audited, because sometimes I don't take all the deductions I'm required. Even though I'm pretty aggressive, sometimes I miss things. I learned a long time ago in business and in life, and especially in an IRS tax audit, it's dumb to act smart, but it's smart to act dumb. Powerful concept that's worked for me over the years. So I just received a few days ago in the mail this letter from the IRS. I know when you get a letter from the IRS, you're scared to open it. I was in the car because I pulled the mail out of the mailbox as I was leaving, and I saw that. And rather than just set it aside, I figured I might as well find out what's in this. So I pulled over, parked the car on the side street, opened it up, and lo and behold, here's my letter that says, adjusted refund. The IRS found nearly $275 as they finished my audit of monies I should be receiving. So I'm getting a credit towards this year's taxes since it's so late to use for my tax payments this year. But once again, these happen because I don't think you need to be fearful of being a tax audited person. The key to understanding this whole business is you need to avoid taxes, not evade taxes. Tax evasion is illegal. There are so many, and we'll cover a few today, so many legitimate legal deductions you're expected to take as per the tax laws that some agents miss. We've talked about several before. I mentioned this a few months ago and I'll mention it again today. This is the last year, this year and the year before taxes, where you can take 100% of your qualified business meals as a deduction. So many of you, if you never heard this before from me, may want to go back and look at your last year's tax return, 2021, you did in 2022, and did you take 100% of all your qualified business meals with yourself and your clients, or do you need to amend that return? This year, obviously, no excuse. You're here today. This is the last year you can do that. It was a grace period, or I guess a kind thing that our government did because of COVID. Makes up a lot of extra money for some people, especially those producers that are entertaining a lot or taking people in nice places to have a lunch or a dinner and do business. So I suggest that. And by the way, probably the best place to read that is in many different websites. I'll talk about those in a bit later. But more importantly, let's just get started with where we're going today. Take a look at some tax tips that I think you must know as you move forward in this 2023 tax season for your 2022 taxes. Lots of deductions, loads of deductions. I'll make this list available. You can go online and just put tax deductions for real estate professionals in a Google search. You'll find even more different lists than this one. This is just one I pulled off the internet. It's pretty common. Most of the 100 are about the same, but some companies, some tax companies, some attorneys, some people that write this tend to have a few different ones. But I think any one you pick, if you're making sure you're taking all of those deductions, you should be in fine shape. You should be in fine shape. And if you get audited, they might find some that you forgot. So once again, avoid, don't evade. Again, as we go further, realize that you should be talking to your tax accountant and your attorney before you do anything that we recommend. In my humble opinion, these are valuable tips that can work for you. You need to verify what is there with your accountant and or your attorney who handles your taxes. Because I'm not really giving tax advice, I'm giving you tax suggestions that have worked in Wayne's World. And they keep working. So with that said, realize, a quick disclaimer, that I am just not here as an attorney, as an accountant, and I'm not affiliated with anybody to provide tax, legal, or accounting advice. That's something you have to take. I hope I arouse your curiosity, stir your imagination, and allow you to say, hey, I heard that, Mr. or Mrs. Attorney, Mr. or Mrs. Accountant. Is this something I should be doing as a real estate agent, as a real estate professional? So consult those legal and accounting people to make sure you're doing this in a way everybody's comfortable with and is a legal tax avoidance strategy. Several common ones pop up. One are your commissions paid, and many of you pay referral fees. You pay sitting fees for open houses. You pay showing fees. You bring lunch to the places. You let your people go out with you and overview what your listings you have, and you buy meals. You've got a lot of expenses. And by the way, we are in for, I think, a little extra bonus because we paid so much for gasoline. This year, this is the highest it's ever been. You can write off 65.5 cents for every mile you drive if you use the straight method and don't depreciate. And depending on how you travel in miles, that's a decision you have to make when you get a car. Should I take actual expenses or should I take the standard mileage deduction? Personally, for me, I don't drive a lot of miles and I don't have a lot of expenses because of warranties on the cars. I'm much better off taking the 65.5 cents this year per mile and keeping track of my mileage. And once again, a mileage log is critical. We are real estate agents. We don't always like details. We don't always keep track of our mileage like we should. Software packages, things you can do that automate this process, very, very good. Because record keeping is the key to your success in any audit. Can you prove what you said you took? See, you're basically, I don't like to say it this way, but it really is this. You're basically guilty at a tax audit till you prove yourself innocent. You wrote it down under the penalty of perjury, you signed it, and sometimes you never get audited. And so whatever you said, they said was obviously correct. Once you get audited, now bring the stuff that justifies this, and this. These meals, these purchases, this stuff, that stuff, these stuffs. Stuff is what they want to see in the form of receipts. We got methods to do that these days. Epson's got a new product out that lets you slide any receipt in there and it goes into a file. Great, great, great package. I don't know how much it costs, but wow, that would be a good investment, which you could write off on your Section 179 deduction and expense the whole thing. Why make it difficult for yourself? Why bring a stack or a box of stuff to your account and say, here it is, sort it out? Why not see what's happening? So maybe by next October, when you get a feel for what's going to happen with your tax obligations for 2023, payable in 2024, you'll know I need to buy some Section 179 tax deductions to write off some of my income. I might as well get this stuff now and write all that expense off against my income because I had a great year. That's avoiding taxes, not evading taxes. So commissions paid and money's paid out, you should not overlook, since this stuff can add up quickly, not just the commission check you receive. Your home office deduction, kind of an interesting one. You might need some time on this one. Most agents fill out a Form 8829 that goes along with their Schedule A, or they use in their business Schedule C. But there's a lot of other ways of doing this. See people do by room count. I'm not suggesting that you avoid this. I'm just saying, in my humble opinion, I have never depreciated the value of my home office in relationship to the size of my home. I didn't want to have to go back later and recapture that. I'm not saying I'm right. I'm saying that's a very important question you need to ask with your financial planners, your accountants, your attorneys. Should I be depreciating my home office in terms of the size of the house or the square footage, whatever method I want to use? And in most cases, if I do depreciate, it's the number of rooms, unless I have a huge house. See, if I have a 2,000 square foot house with 8 rooms, I could take 1/8 of that Or I could take the square foot method of how big is my office compared to the 2,000 or 3,000 square feet. Whichever one works better is the one you keep using. On the other hand, I choose not to use that at all. I'm happy taking the rest of my deductions, not having to recapture that when I sell my personal residence because I used part of it as a depreciable asset. But again, my accountant and I, for the few times I ask him for results, says, yeah, you're probably safer. That just opens up a can of worms that you may not want to have a can of worms opened. So if you understand the home office deduction is a tremendous tool, but is it worth using the depreciable square footage or the depreciable room count, whichever is better for you, because the IRS lets you use both in that process? That's all we're saying. That's all we're saying. Third thing that pops up is desk fees. And this gets very difficult if you're deducting your home office and have desk fees. So once again, it's there. You have to decide how you're going to handle that. More and more companies are letting you work remotely and you never go to the office or never have a desk fee. Even some 100% agents are avoiding the cost of the desk fee as they pay their assessment to their 100% brokerage business, and they have no desk. They just come and use an open desk, or they go in the office very little, or they just use the conference room. But that's between you and your brokerage. But to have the $400,000 or $500,000, $300,000, $800,000 office may or may not make sense. On the other hand, we have some states, Illinois is one, that allows a lot of agents to open their own little branch office with their company name on, just for their team or for themselves. As long as they follow our Illinois license law requirements and the brokerage approves of that, we're seeing a lot of storefronts, a lot of shopping center stores that have a real estate office in it for a team, like Team Wayne at eXp Realty. Meets all the requirements of the state of Illinois, and I have my own little place to go to. Boom. But that creates some issues then if you have an office at home. So once again, accountant, attorney, somebody's necessary to make sure you're doing it according to the tax code. It's not worth thinking you're doing it right if you're not sure absolutely you're doing it right. I run a lot of stuff by accountants. I do my own taxes. Thank God for Excel spreadsheets. But I'm very careful on some of these things. Education and training. I'm a person that firmly believes education is from womb to tomb. I had the privilege of doing a large investment seminar 2 days ago for a large franchise in Chicago. I got a few other things planned. I love bringing my advice, my thoughts, my methods on wealth building, negotiations, closing sales, handling objections, and just in general, sharing some of the new techniques, i.e. ChatGPT. Probably the hottest one right now for most of you. So with that said, we have to realize that all your education, all your training can be tax deductible. Traveling for your training, going to an NAR convention, a company convention, a regional meeting, anywhere you travel for business, a seminar, anything related to improving your business, all your expenses are deductible. Again, as you can see in the 3 bullet points, you can't be going to a different business. But in real estate, if you decide that you want to be a owner of a company and your state requires a different set of hours of credit, those are not deductible in many other occupations. In real estate, it's considered still real estate. So even going from in Illinois, managing broker to designated managing broker, from broker to salesperson, all my extra courses, all my extra books, all my extra items. I just signed a subscription, as silly as it sounds, to get a newspaper from the Chicago Tribune on Wednesdays and Sundays. It was so cheap, I couldn't believe it. But number one, I can write it off. And number two, Wednesdays have some good information. And Sundays, I probably throw half the paper out, but take the real estate section that's a separate insert and use that. Plus, they'll send me other things that relate to real estate. So I'm writing off my subscription. So be careful and make sure your accountant, or you, if you're doing it, are doing all your training, education, and relationships to basically are there to maintain CE credit, designations, travel. Many of my friends are going to the MIPIM conference in France. Some people will go to some other conference that's international, or just traveling to your regional conventions. Just keep track of all your expenses. Education and training is a part of what makes us better. And to me, in Wayne's world, education is from womb to tomb. Number 5, marketing and advertising. A lot of things out there. Many of you know what pop buys are. Many of you do little tchotchkes and other ways to keep in touch. Some people are using more print advertising, your postage. I just found out something. I can buy stamps on eBay cheaper than going to the post office. This blows my mind. I never knew that until recently. I order a roll of stamps off the internet, eBay. And now I can send some thank you notes out, because there's a lot to be said about still using a printed thank you note that somebody gets, or maybe a 1-year anniversary note that somebody gets in the mail. But all your staging costs, all your photography, if you choose to buy your own drone and write the whole thing off on the Section 179 deduction. I'm seeing also a revival of billboards. A lot of agents across the country are investing in a monthly or quarterly billboard campaign because people are back on the road. One of the best deductions is what you can do for marketing and advertising. I personally, in the height of my really active selling career, when I would be carrying my 60, 70 listings all at once, I roughly was spending 22% of my income as part of my business plan on marketing and advertising. Roughly 22%. So if I made 100,000, 22,000 was my expense. If I made 200,000, I just doubled it. The bottom line was that was my method in my marketing plan, marketing and advertising. J.C. Penney said something years ago. He said, I am spending millions of dollars on advertising with all you ad executives. And I know I'm wasting half of that because people throw the stuff away, don't even open it, don't even see it in the magazine it's at. I'm wasting half of all that budget. If I just knew which half, I could save money. Because the worst thing you can do in a slow market or when you're not making enough money is stop advertising, stop marketing. Because slowly but surely you are easing yourself out of being remembered. See, it's your identity, your repetition, and your consistency. And so since you can write all that off, build that identity. We call it a USP. Now it's called a UVP. Identify the consistency on a regular basis. My highest marketing in the mail campaign was a 4-page newsletter called Coffee Break. 7,000 people got it 7 times a year in the mail. Consistency, same image, same pictures, same back page advertising me and my partner, ability to get you to Florida home sites back then, as well as sell and buy in Illinois. And the repetition and the consistency. So I looked the same. The paper was the same. They saw it came in an envelope that was an odd color. And when we mailed it, just to be different, now postage wasn't as high, we had all 1 and 2 cent stamps across the top. So when they pulled it out of the mail, the color of the envelope wasn't white, and because it was a fold-over brochure. And there was a whole row of stamps. That envelope looked different. Well, I better open this up. Oh, that's Wayne's newsletter. Oh, Coffee Break. Wow, I didn't realize. Whatever you can do to pull yourself out of the commodity market into the specialty market is going to be based on how much you spend on marketing and advertising, which is 100% tax deductible. I'm a very solid proponent in my seminars of many sponsors, but one sponsor that stands out is Cutco Knives. Not to recommend the knife, but to recommend the marketing plan that they put together for you as you give out gifts. Because the IRS limits your gifts to $25. You can't buy much of a closing gift for $25 and write it all off. but that company and their product allows you to deduct 100%. Talk to one of their dealers in your area. Number 6 is the auto deduction. As I said, it keeps going up, keeps going up. Look at it, was 56 cents. Now it's up to 65.5 cents. That's a pretty good chunk. You know, if you drive 100 miles, that's $65.50. You can write off for every 100 miles. And look at what you keep track of. So again, good record keeping solves the problem. The office supplies and equipment, once again, people overlook the ink they buy for their printer. They overlook some of the things they do in their office that could cost them money, just little things. Some of the ad specialties you buy, the pens, keychains, the flashlights, that's all part of supplies and marketing, but it also could be part of your office. Some of you have signage that you use when you go out to open houses with your picture on as you set them up in the rooms. A lot of that all falls under office supplies and equipment. But more importantly, the copiers, the computers, that new scanner that Epson has to scan your receipts right in, and it stores it in a file for tax purposes. Expensed in full in most cases under a 179 tax deduction. Consult your accountant. That's all I can tell you. I'm not one. I don't want to be one. I'm happy being a real estate professional. I'm happy to be a realtor and a realtist. I'm a happy camper for all my life, being a realtor and now being a realtist also. I said earlier, again, 100% tax deduction due to COVID. Last year and this year, you can file an amended return if you and your accountant thinks it's worth it. And you can surely take care of this year's tax return by looking at all your meals that are qualified business meals. And once again, Overnight Accountant is a great little Google search to go to. They put a lot of good material. It's overnightaccountant.com. There's so many, I can't list them all. I'm not endorsing any, but I find they're easy to use because they say things I understand. And there's many law firms that set out some things, many accounting firms besides a group like Overnight Accountant that sends out things. The more information you have, the better way you can reduce your taxes by legally avoiding versus not reporting everything or not making honest numbers there. With that said, all your memberships. I said I'm a realtist. I just paid my dues, $180 to be a realtist for another year. Pretty soon my realtor dues will come, my MLS dues. If I belong to chambers of commerce for marketing purposes, belong to organizations, maybe it's the National Speakers Association for me. Maybe it's a group of brokerages or businesses you belong to. Maybe it's some of your membership fees to be keep your NAR designations. All your licenses, all your fees, and all your insurance. If you have an umbrella policy with E&O insurance and you pay for it, don't forget that. We have a lot of expenses that we sometimes don't remember. Now be very careful with RPAC because not everything you do in RPAC is deductible. Maybe you do some things with other organizations. As long as you can show it's for business purposes, it's okay. And don't forget, as a self-employed individual, you get an income tax deduction for half of your self-employment taxes. That seems to be a common error some people forget to do on their 1040. Again, I guess I'm just reminding you today, as well as sharing some new ideas and new feelings that might be helpful to you as you enter into the marketplace of doing your taxes this year. The last one, software and business tools. There's tremendous software out there that you might have to buy. Maybe you are paying an extra payment every month to your company for use of their software. Some people include it in an annual fee or a monthly fee, but just realize products that help you automatically track your expenses and mileage may be fully deducted on that section 179. So do me a favor. I'd love to hear from you, Wayne at WaynePaprocky.com. If you buy that new Epson scanner that lets you put everything in real simply. Shack has been advertising it. And Epson does have a lot of good products. They have the printers where you have the ink tanks instead of the small cartridges. And there's a deal too. I learned the hard way. I bought some cheap ink one time off eBay because my Epson ink was getting low. And I figured, why should I pay all this money? Then I realized once it clogged my machine, why I want to put Epson ink in my Epson printer, fax, and scanner combination tool. Had to clean it out. Decided to not leave it in there, so I lost most of what I spent. Didn't lose a lot of money, but the cleaning and the frustration weren't worth it because I can write off all the ink anyway. Your choice. With that said, now let's look at a few other things. Gifts. I mentioned $25. I mentioned Cutco. Enough said. A gift is limited from the IRS. So look for a marketing company that will allow you to use the things you give and marketing campaign that's tax deductible versus a gift that's limited to $25. That's all we're saying here. And again, be very careful giving gifts to people for referrals. In some states, that's illegal. Your health insurance, I would suggest you just download for free Publication 535. That's the best way to realize what you can do with all your health insurance, your premiums, your deductibles, and everything else you do. Some of you are on group plans. Some of you are taking some of the realtor group plans. Sometimes your company has a group plan. Just find a way to make sure you're getting all your taxable health insurance done. Publication 535 does that very, very nicely. With you being a real estate agent, again, the receipts are critical. I think this is probably today more detail than you need. I believe it's worth it now because I just saw that Epson product recently. I never saw anything similar to it that seemed to work as well. And I was actually on paper records for mileage. I used a product called Daytimers. Every month I carried a book around, and that took care of everything. And I'd take my book, my 12-month little books to the IRS audit, and they'd say, okay, let's talk about your mileage. I'd say, pick a month, and they'd pick a month, March, pick a date, 22nd. Here's what I did. Boom, boom, boom. This adds up. And I did a couple of random selections, and they said, okay, you're fine. But do realize you got to reel in your real estate receipts. It's easy to put something in a glove box. I just went for a car wash. Saturday because it was the junk. Here's my receipt. Now I got to go put that in my file to remember. It's on my charge. So I know it's on my charge. I know I got my receipt. I'm ready to go. That's Saturday. Now, some people just forget about those, throw them away, whatever they are paid cash. Now it's really a problem. At least I got a record on my credit card to prove and a pattern that shows I go to that car wash and my car washes so much every time I go. In the spring, I'll get the car detailed. All that detailing cost, interior, exterior, engine, rims, whatever, full, complete detail, tax deductible. Wow. What a good feeling to know that we have a career path that not only gives us time freedom, it can also give us tax savings freedom. There's also something called the PATH Act. And that's basically where we're talking more about the Section 179 deduction. And I used an example in last year's taxes because I haven't done this year's taxes. But I could write off up to $27,000 the price of a new car for the tax year in which I bought it. As prices are going up, there's some new limitations. I would take a look at the PATH Act and how it affects you if you plan on buying another vehicle and the best way to do it. Because numbers change. I'll show you some numbers that pumped up this year on one of the tax returns in a few moments. So I'm giving you some places to go after you leave here to share with your accountant if they don't know about it, or your attorney, to make sure you are doing exactly what I want people in Wayne's World to do. It's one of my 10 commandments. Avoid taxes like poison. It's nice to get a letter from the IRS that says you got some money coming back. We found even more deductions for you. That's a win-win relationship to me. This is almost too small to see, but the bottom line is you have to realize you got to take advantage of every tax deduction you can. Even minor little things add up. Maybe your parking costs. Now, I think most of you probably are on some kind of an automated toll system. But what's nice about at least my Illinois tollway system, I can print each individual toll on a monthly basis, and it reminds me to coordinate it with my mileage. So I drove to a seminar in Burr Ridge, Illinois from Northbrook, Illinois. I forget how many toll booths I went through because I had an autoresponder. But when I come back home, I can download that trip and see I went through this exit, through this exit, through this exit, and it cost me $4.20. I park in Chicago. Might cost $15, $20, $30 sometimes. All those things pop up. But look at the list here. Your coaching, your training. I have 27 students in my coaching program. They pay me on a monthly basis. Some people just do a one-time coaching call with me. People have renewal fees coming up, dues. There's loads of things on there that you can be looking at. All I'm suggesting is this is something that needs to be done, and here we are. Maybe you're going to lose some things from last year because you didn't keep good records, but you're still early enough in the 2023 year to start putting together a great package with some of the great ways of keeping records, the filing system, the scanner, whatever it is, so that when the 2024 taxes come, you're just pushing a few buttons and sending a bunch of stuff to your accountant or doing it yourself. So what you didn't do in 2023, if you can't, in 2022, if you can't grasp it for this year's tax return, at least don't do the same thing this year and not keep good records or not have the equipment you need or be using an old computer or whatever the case might be. We're looking at all different kinds of technology advances. We've got smartphones that do so many other things. You can buy the wrist, the Galaxy and Apple have the wrist phones that allow you to document things. That all stuff is tax deductible. Something else I'd like to share, and that's very simply the safe harbor rules for rental real estate. The IRS issues proposed what are called QBI deductions, qualified business income deductions. This is something you probably either want to spend a lot of time on your own or make sure who's ever doing your taxes is taking advantages of all the rules that are there to help you for rental real estate. And as you know, in Wayne's World, 2 properties a year. I was doing a seminar on Saturday from 8 till 2, which I've been doing for 3 or 4 weeks. And that morning, a gentleman sitting right by the door inside the building where I'm going to be, in the room I'm going to be in. And I thought it just could be somebody telling that, their friend or their spouse couldn't make it. Can they sit in? I don't know what it was. This guy says, "Hi, Wayne. I saw you were here in this town doing this seminar, so I drove just to say good morning. I took your investment seminar 30 years ago. Guess what? I followed your rule. I have over 60 rental properties. Drove all the way just to say hello, and that he did that 30 years ago. And he's taken the advantages of some of the tax benefits, and he reminded me of a few things about this, that, these, and those. I would love to see you face to face at a meeting someday, somewhere, maybe a NAR convention, NAR, maybe a Illinois Realtors convention if you're in Illinois, maybe at a company convention that I'm attending or speaking at, and just say, I was on many of your Facebook Lives. And guess what I did? Boy, that would make me happy. Make me so happy. So QBI is a pretty important element that I think you need to address as you build rental real estate. And there's many law firms that seem to address this a lot. And so just go online and Google QBI deduction. And you should get a number of good websites to read, find out about, or maybe even look at some templates of what they do, some samples of a return. But it's something you cannot overlook. If you overlook the QBI deduction and you have rental real estate, I think you're missing out on a tremendous amount of legal tax deductions that will avoid your taxes. Very, very, very good system that's out there. A couple of other things. This QBI has a lot of parts to it. It's a section 199 of the tax law. So section 179, as we've been talking about, is the able to write off all your expensed items in 100%. But this is qualified business income, and so I suggest strongly you cannot afford, if you have rental property or as soon as you start getting rental property, to be looking at the QBI. Or let somebody else make sure they understand it as they do your taxes. Now, this slide is rather intriguing. To me, it's very important because the Tax Cuts Act in 2017 included a 20% deduction for you on your business as a sole proprietor of real estate. And it continues on through section 199 for many years. But for 2023, the threshold is up to 182.1 for a single taxpayer, or 364, and I think there's one extra zero in there for some reason, 364,200. I forgot the decimal point. So, I mean, this is a big chunk of money that will allow you, if you're within those thresholds, to write off 20% of your income as a realtor. Somebody else doing services may not qualify for that process. So make sure you talk to your accountant and or your attorney to make sure you're taking advantage of the Tax Cuts and Jobs Act of 2017. If you make a lot of money in this business, and most people don't, we still seem to feel that the numbers are still about where they were before. Roughly 10% of the agents that are NAR members earn 90% of the income. So the average income probably qualifies for these income thresholds as single taxpayers or married taxpayers. So this is another one to write down and say, I got to check on this one too. So I think today's time together creates more time later on. Because if you're done with me today and never think about this, you missed out. You're not taking this hour of time out of your life. You're going to be taking a few extra hours out of your time to implement what you learn. See, knowledge is not power in anything. I think that's a misnomer. Knowledge in Wayne's world is only potential power. It does not. It does not. Knowledge does not become power until you use it. Calvin Coolidge, in one of his many speeches, one that McDonald's was using in training for years, among all the things he said the world's full of educated derelicts. There's loads of people who know a lot of stuff, but they don't use it. I don't know a lot of stuff. But what I know is, if it's related to a business, how to buy a business, how to sell a business. So the real estate, how to invest in it, how to maximize my tax benefits, what are the trends, what's going on, I know that. So I have my limitations, like we all do. Right behind me is a wall full of books, all the greatest books in the Western world, the Annals of America. Those are there, so my office looks good. I looked at a few of the top books. I've never opened up the Annals of America. And there's some other books at the bottom. It looks good. More importantly, I know what I need to know. So with that said, realize knowledge is not power. But you got some thresholds here. And these are powerful thresholds. Wow. So as we wind this down, a few other things. This slide is a bit more difficult to read, and I'm sorry for this. I didn't realize it till this morning. It was too late to change it. But I wanted to show you how the changes in the Tax Jobs Act go through the next several years, because that expires in a few years. I think it's 2026 is the last, 2025 is the last year it's in place, unless Congress renews it. So you do have a few more years to use this. So if you haven't started using this, you still can amend returns. IRS says up to 3 years, and you could start using it for the rest of the years through 2025. So you've got basically 4 more years. Don't overlook it, please. It's too critical and too important not to. I think we are saying what I believe all the time. My goal was to have you avoid taxes like poison. That's the number one best tax loophole that's legal. Just make sure you are taking every single deduction that you have available to you. And the only way you do that is keeping good records, but more importantly, knowing what records to keep. And so we've covered some of the major ones, but I got a few more things that relate to your general tax return, not just your real estate tax return. So, just to give you a perspective, tax avoidance, legal things, legal loopholes, done before tax liability, very few penalties or imprisonment. Tax evasion, illegal. Employing illegitimate means, done after the tax liability, penalty or imprisonment. Good example. I just had to stop over at one of my buildings and pick up past due rent from some people that were going through some struggles and had some expenses. So I gave them till the 15th to pay the balance. So I went to pick it up. And here's my building manager comes out. She manages that building and she gets paid for that. And her rent is the same as most other tenants in the same size apartment unit. So instead of me just taking $500 off a month and say, just pay me $2,000 instead of $2,500 or $3,000 instead of $3,500, I make sure I give her a check for what she earned that month before I collect her rent for March. So I brought her check that I owe her for her services. She has it now. Now that money she can have in her bank account. So when she writes me a check for March rent, it's the full amount. I have that paper trail now that says I pay so much a month. I can write that off, and my rent has not been hidden. Because if I said, okay, I'll just take $500 off every month of your rent. Well, first of all, I'm showing less rent. I'm avoiding income. And she may or may not be reporting any income. So we got all kinds of tax evasion problems trying to set it up that way. This way, I've got a clean paper trail. By the 20th of the month, she gets paid her monthly monies. So when she pays next month's rent, there's enough in there from the money I gave her to make the full rent like everybody else. She's not treated differently, except in Illinois, the law says I have to put on her lease rent concessions granted. That's just a law in Illinois. Don't know where it's at in every other state. That's all I got to do. So all I'm saying is stay away from the right side and work on the left side. It's easy for you to remember that because I'm left-handed. I'm a tax avoider by nature because it's on the left side of all the forms I use. Not a big deal. Now, one of the points I mentioned I'd be covering today is how to win with aces. And I have this theory that people in society all are at different levels of wealth building. I have no problem with a person making $30,000 or $300,000 if they are building wealth. Are their assets minus their liabilities growing at a rate greater than the inflation rate? What they owe minus what they own minus what they owe is growing at a faster pace than inflation. So last year, if you didn't grow about 10% of your net worth, you actually are falling behind. That's another whole seminar. But usually the people that are wealth building at every level, lowest tax bracket to the highest tax bracket, win with aces. Aces are usually a good hand in any card game. 4 aces, there's not a lot of cards that'll beat you. If you're playing a poker game where deuces are wild and you got 4 aces plus a deuce, I don't think anything can beat you, or maybe 1 or 2 things at the most. What does that mean? Wealth builders in Wayne's World. Fill out Schedule A, itemized deductions. Fill out Schedule C, profit or loss from business or profession. Schedule E, rent and royalty income. And Schedule S, self-employment. It seems to me, as I talk to people. Just ask the simple question, not how much money. Are you filling out an A, a C, an E, and an S? Once you start doing that, it seems like you are accelerating your wealth at every level. And sometimes at the lower income levels, it's even more dramatic than at the upper level, because those people have accountants that find even more loopholes. So take a look at that. Now, with that said, we changed the tax laws several years ago with avoiding the SALT tax, state and local taxes. That's messed up a lot of people on their Schedule A, especially in some states where there's high taxes, like in Illinois. So my recommendation to all my investors that are on my coaching calls or however else we meet is, if you have income property, get yourself a HELOC on the income property. Pay off your first mortgage on the home with the HELOC, and now you're moving your first home mortgage to one of your properties or several of your properties. Just spread it out if you have to. And now every single dollar is tax deductible against your business income. And you no longer have a lot of deductions on your Schedule A, which means you're probably better off using the standard deduction. And the standard deduction went up a lot this year. It's a big increase. So I'm calling people to look at that method, or something I call leapfrogging, where you pay 1 year by itemizing, then standard, then itemize, and you dump things in. So if this is the year I am itemizing in 2022 that just finished, and I had a home mortgage or some expenses, medical, whatever, I would tell my dentist, I would tell my lender, I want to pay you in advance for 2023. Many people have paid their state property taxes early in 2022 to be able to deduct them on that year's taxes. And so at the end of 2023, I'm only taking the standard deduction and I'm leapfrogging. So standard, itemize. Every year I'm leaping over and I'm reaping some benefits by combining my bills. So in some years where I itemize, I've got 14 months of bills. I paid early the beginning of last year, and I paid late into the next year some expenses. It's a tough, crazy idea, but it works if you do that. But I'm starting to see with the SALT tax stuff, elimination, it's better to maybe just look at moving as much as you can, your medical, your contributions, everything over into your business accounts, which are deductible, and just use the standard deduction. Plus, you got less records to keep in your personal tax return. Just a thought. But I do know, as we close this down, if you win with aces, you're going to be a wealthier person than if you don't have those 4 aces. You still can have a winning hand. You still can do well every so often, but the odds are for you if you've got the A, the C, the E, and the S as a part of your life every year as you start doing your taxes. And if you can find me somebody who you believe is very wealthy who doesn't use all those 4, I'd be glad to figure out why or how they were able to do that without. But for most Americans, for most people, and especially for most realtors, A, itemize, C, business, E, rent and royalty income, and self-employment income. We are a natural to move with aces. But for some reason, we all don't do that. So very, very important. I leave you today with a thought. I can't change what you didn't do. The past is history. The future's a mystery. Today's a gift. That's why we call it the present. So today in the present, take a look at all the things you jotted down, all the things that show up. Maybe watch it over again on my Facebook site when it gets posted by Facebook. But no, above all, find somebody who you respect, who's good at doing taxes for real estate professionals. Because sometimes just a regular tax person may not be as adept at all the real estate professionals. I learned a lot over the years, many years ago, from a man named Vern Hoven from Missoula, Montana. He told me, he shared with me, he wrote books about specific things for real estate agents. But I also took a tax guide because I was teaching some seminars at Roosevelt University. I was the first instructor for the MBA program. And one of the instructors there showed me tax guide for college professors. Because now that I have this side hustle of teaching a college at a university, I've got different kinds of deductions as educational expenses that I could write off on my 1040 at the top. I could adapt much of that to real estate. So the sense to specialize is not only good for you buying income property in your real estate business, it's good to find an accountant and an attorney who can give you tax advice on real estate matters. You know that from closing. Some agents don't know what to tell their clients as to what they can deduct off of their title searches and their costs of closings and everything else. And some people, I'm sure, are missing out on a lot of tax deductions as they buy a home with a realtor who doesn't give them good advice. In my humble opinion, it's sad, but true. So we did it. You did it. I'm glad you're here. Last full week of February, wherever you're at, good weather, bad weather, enjoy the day, enjoy the week. And the last thing I can say is I'm glad you're in Wayne's World, and have a wonderful week, and do something special for somebody else.